All right, well, welcome to chapter 19. We'll look at a little bit about earnings per share. All right, so earnings per share is a measurement in order to tell our common shareholders what portion of the company, their available income, what is associated with the shares they earn. So if we were to wrap up the organization, how much of the equity of the organization is attributed per share? And they can do the simple math based on the shares that they own. So some of the different pieces to consider are the fact that the common shareholders have residual interest. Therefore, whatever is left after paying liabilities, paying preferred shares, all these other debts that they might have, it's what's left. And something to consider when you're looking at earnings per share calculation is how is their allocation affected by preferred shares or other convertible debt instruments. So these earnings per shares calculations consider some of those components. The basic calculation looks at the income available to common shareholders divided by the weighted average number of common shares. So it looks at opening common shares and looks at migration or addition or subtraction of number of shares throughout the year, and that determines a weighted average number. There'll be two EPSs that an organization has to calculate. One is a basic, which just looks at actual earnings divided by actual number of shares, period. And then there's a diluted version, which looks at the what if. What if the convertible bonds or preferred share instruments are converted? What if the options are exercised? Things like that. And that determines a diluted earnings per share. And they're both required to be calculated. Under IFRS, you have to disclose it. Okay, your earnings per share, both diluted and basic. Under ASPE, and I just realized that acronym spelled wrong, but under ASPE, it's not required, but it's usually presented if it's easily available. It's typically on the income statement and it's presented below net income. So it's on your statement, your income statement or statement of financial activities. Your earnings per share is disclosed for continuing operations, discontinued operations, and net income. So it allocates the different components. So you can see, what is likely to be repeated in the future. And as I noted just a moment ago, if the share structure is complex, so there might be, convertible instruments, et cetera, the earnings per share will include both basic and diluted earnings per share calculations. And that's for all periods that are on the financial statement. So if you have 2, 3, 4, 5 years, you would match that presentation. Some of the calculations, basic, looks at only simple capital structure. There's only common shares, preferred shares, and or debt with no conversion rate. So it's just simple. And that's your basic earnings per share calculation. And then when you have to do basic and diluted, that is when you have potential common shares that exist. So again, convertible bonds, convertible preferred shares, options, etc. So when those conversion rates are exercised, those instruments might have a negative effect on earnings per share. So they have to be considered and disclosed. Under the basic side, the income available to common shares is net income, less any preferred share dividends. If the preferred shares are non-cumulative, we only deduct declared dividends. Okay. If they are cumulative, then we need to deduct declared dividends. Okay. But it says, not including arrears because they would have been included in previous year calculations. Or if no dividends are declared, deduct only 1 year's dividends. So you always have to make sure that if you have a preferred share dividend that you are removing it, whether it's declared or not. You need to subtract those preferred dividends from net income, and it could result in a loss. Just keep that in mind. Dividends declared on preferred shares are subtracted from income from continuing operations and from net income, but they do not have an impact on discontinued operations. Okay, so any dividend reduction is from continuing and from net income. Looking at the average number of shares, when you look at weighted average, you need to consider when transactions took place. So if you increase the number of shares at a period of time that wasn't the full year, you need to weight it by the number of months that they were in force or in issuance. So that denominator, the common shares, are weighted by the period of time. Any stock splits, stock dividends, et cetera, require a restatement of weighted average number of shares outstanding before the stock split in order to have valid comparisons between periods before and after the event. And sometimes you will assume that the split or dividend occurs at the beginning of the year. When we're looking at the diluted EPS, when there's a more complex capital structure, when there are potential common shares due to the conversion of convertible securities, some options, some potential stock warrants that could dilute earnings, you need to consider those. Dilution means a reduction in earnings per share if any or all of the securities are converted. So that's just something to consider to understand the word dilution. And any impact on anti-dilutive securities are not reported to be conservative. Okay, so if you have a conversion that might actually increase the earnings per share, which is possible, you would not include that. Okay. And whenever you have various complex capital structure in place, you need to rank them from lowest to highest. Okay, options are always first. So lowest to highest as far as the impact on diluted earnings per share. Other things to remember, let's assume the conversion happens at the beginning of the period or the time of issuance. Okay, so the denominator of the earnings per share formula is increased by the additional common shares assumed issued. The numerator is adjusted for interest net of tax and or preferred dividends. And you have to consider the impact on net income and the number of shares outstanding. So just remember, if you convert a bond to shares, you wouldn't have to pay the interest on the bonds. That's what this means by adjusting for interest. So if those bonds were converted, you'd have more shares, but then you'd have less interest expense. Conversion, again, systems always have to be in a year. If they're issued during the year, then the conversion is prorated for the number of months. Remember, you only consider if it's dilutive, and you must consider the interest impact. All right, moving on to options and warrants. Remember that any options we talked about in the previous chapter in this course, it gives the holders the right to buy a call option or to sell a put option shares. So you have to consider what would that impact be. The holder of the option will exercise the right typically if they're in the money. So if they're going to make money, that's when they're typically exercise the option. If a company does sell or write options, we have to include it in our diluted earnings per share if they are again dilutive. And sometimes, purchased options are always anti-dilutive because they will only be exercised when they're in the money, and they will always be favorable to the company. So just keep that in mind as we go. Treasury stock method, this applies to written call options. Excuse me, and it assumes that the options were exercised either the later of the beginning of the reporting period or the date of the issue. Any proceeds are used to purchase common shares at the average market price during the year. And the exercise price of the option must be less than the market price per share for a dilution to exist. So keep that in mind. If the exercise price is less than the market share, it will dilute the earnings per share. Last few things is disclosure. In your financial statements, you will have to disclose what numbers have you used in both your numerator and denominator for both basic and diluted, and for each year that's in your financial statements. You would disclose any securities that could dilute, but that are currently anti-dilutive. So you would list them in your notes. They wouldn't impact the financial calculation. And you would outline any common share transactions after year end that would significantly change earnings per share. So if you had some common share transactions that happened after your fiscal year end, but it was prior to you issuing your financial statements, you would include those as subsequent events. So the process then for the diluted earnings per share would be you calculate the basic, you would calculate the dilutive effect for each instrument. You would eliminate any that are anti-dilutive. You would rank the remaining convertible instruments in order of dilutive effect. So the one that dilutes the most down to the lowest. You would calculate the cumulative diluted earnings per share, taking into account each convertible instrument, starting with the most, working towards the least dilutive. And then if the calculation of the diluted EPS does not result in a lower diluted EPS than the previous calculation, then you stop. And that lowest diluted EPS is what gets reported. So that's the theory behind it. Hope that helps a little bit.